I am going to talk about the Genius Act a little bit later in the presentation here, but this is some of the presentation. It's kind of I've evolved it since I spoke in Prague about a month and a half ago, but this is an important subject, and it's one that I get asked about all the time about institutional adoption of Bitcoin. And so, as Laura said, for those of you who don't know me, I'm James Lavish. I'm the co-managing partner of the Bitcoin Opportunity Fund now. So I'm a reformed hedge fund manager, and now I'm focused on some emerging assets here. But I've been an institutional investor for over 30 years, managing capital from hedge funds and arbitrage to now Bitcoin and macro strategy. And over that time, I've learned one thing above all, and capital always follows incentive. And today we're watching those incentives shift under our feet. What we're going to talk about today is why Bitcoin is not just an asset class, it's an inevitability. Not just because it's trendy, and not because it's digital gold, but because it's a natural response to a financial system that's reaching the limits of its own design. So let's start with a simple question. What happens when the asset you built your entire portfolio on, the ballast of your portfolio, stops working? For decades, the US Treasury, the 10-year US Treasury, was the world's safe asset. It hedged drawdowns, it paid real yield, it helped you meet liabilities. Today, it correlates with equities. It yields less than inflation as measured by the expansion of the money supply, and it adds volatility, not stability. This isn't policy error, it's the policy, the tool the government uses to suppress real rates and manage unsustainable debt loads. The result? Cash and bonds are no longer safe. They no longer keep your portfolio afloat. They're melting in real time, quietly, systemically. And now that the base layer is broken, then everything built on it is at risk. And that risk grows every day. In short, discipline has been replaced by debt dependency. The global economy is now addicted to credit expansion. Total global debt is now $324 trillion. Sovereigns can no longer afford neutral interest rates, let alone restrictive ones. In the US, we're spending over $1 trillion annually just on interest on our federal debt. That's more than defense, and it's more than Medicare. And the response from central banks isn't to deleverage, it's to increase liquidity, to do more QE, to ease collateral terms, to rescue markets again and again. Why? Because we've reached fiscal dominance, where government spending is necessary to drive the economy. Therefore, monetary policy now exists to fund government obligations. This is no longer a cycle, it's a regime. We're in a permanently low-rate, high-liquidity world, not because it's optimal, but because it's the only path left. So let's get something clear, though. Negative real yields aren't a fluke, they're not an error, they're not some post-pandemic anomaly. They're policy, a deliberate feature of a system that's addicted to debt and growth at any cost. The playbook is simple. Governments rack up unsustainable debt. They can't inflate it away overnight, so they suppress real yields. They pay bondholders less than inflation, and they let time do the dirty work. It's simple. Print money, make dollars worth less, pay back debt with cheaper dollars. And it's not a fringe theory either. The IMF itself calls it a subtle form of wealth taxation. And it works beautifully, as long as no one notices, as long as the people don't protest, as long as allocators just go along with the scheme. So why do we have to repress rates in the first place? Why are real yields negative? Because the system does not work without more liquidity. With debt loads so high, the only way out is inflation and money creation. And make no mistake, without more liquidity, the system will simply collapse on itself. This chart shows the global money supply growth since 2000. You can see the acceleration at the 2008 crisis and the vertical move in 2020. Since 2020, we've added nearly 7% a year compounded to the global money supply. For central bankers and treasuries, it's just about survival. Remember that number, 7%. We're going to come back to it. And this is what we mean when we say irresponsibility demands liquidity. More debt, more printing. More bailouts, more printing. More fiscal spending, more printing. And if you know that, you also know this. The purchasing power of fiat is structurally designed to decline. Look at how these move lockstep with each other. And here's the open secret. The system doesn't just tax your income anymore. It taxes your savings quietly, relentlessly, systemically. And this is what ultimately breaks the traditional model. Bonds don't hedge, cash doesn't preserve. The anchor asset becomes the liability. In this environment, the old safe haven playbook is obsolete. You need assets that sit outside this repression loop. And this is now policy. If the base layer is structurally eroding wealth, then allocators have no choice but to rethink what safe even means. Which brings us to the obvious question. What do you own when everything denominated in fiat is quietly melting? That's the question every portfolio manager grapples with every day now. Now let's talk about the elephant in every institutional portfolio, the safe asset sleeve. This chart shows 30 years of institutional portfolio evolution. In 1994, 85% of capital sat in US fixed income. By 2022, that number had dropped to just 4%. Why? Because safe no longer means productive. Bonds don't hedge. They don't preserve wealth. They don't meet future liabilities. With negative real yields and suppressed coupons, they've become an anchor that drags returns down, not a risk buffer. And so what happens? You're forced to reach into liquids, illiquids, privates, derivatives, and leverage. You build complexity. You increase the duration of your portfolio. You add tracking error, all to chase the same 7% nominal return in a world where global money supply is already growing at 7% per year. So it's the same return target, triple the risk, zero real return. And complexity and risk are doing all the work. Portfolio managers are simply hamsters on the treadmill, and we all know it's not sustainable. With rates back up, bonds have entered again, but will soon be back to 2022 levels. It's all but certainty. So we arrive at the real question. What do you own when everything inside the system is either inflated, illiquid, or guaranteed to lose value in real terms? That's where we begin to shift, not into speculation, but into design fit assets. Assets built for this very problem. And that brings us to the institutional mindset. But it's not that easy for institutions. They cannot simply shift their mindset and adopt a new strategy. Bitcoin maxis, you've seen them online, they like to call these people dinosaurs. But in reality, institutions are just more like massive ocean liners, programmed for a destination. And if the captain, the portfolio manager, wants to take a different path to that destination, he must ask permission from a dozen superiors in a rigid chain of command, which looks like this. So then it's not that they're late, it's that they're slow. And it's not that they're slow because they're dumb. They're slow because they're structured to be slow. The job of a pension CIO isn't to chase alpha. It's to meet the intergenerational liabilities that they have through consistent, defensible process. Every decision is accountable to boards, consultants, stakeholders, and as we've seen, to politicians. So if you take a peek at this chart, this is the capital pipeline. What a new asset must pass through just to get considered. Industry research, asset class review, due diligence, committee vetting, board approval, policy documentation, and then ongoing risk management. It takes months, sometimes years, to even reach a decision. And it all starts with ALM, the asset liability management, the institutional North Star. This is matching long-term obligations with asset performance, volatility, and liquidity. An asset must improve the performance, the portfolio's ability to meet those future liabilities. And even so, when a CIO sees a thesis like Bitcoin and has conviction, he still needs model inclusion, consultant endorsement, governance sign-off, and reputational cover. That's a big one. And if it doesn't clear those, it's DOA, dead on arrival. Conviction alone won't get it done. You must navigate the idea through the gauntlet of structure. And that's why Bitcoin hasn't flooded into portfolios yet. Not because it's misunderstood, but because it has to fight its way through this institutional process. That's changing now, though. Bitcoin is winning institutions over and earning an allocation in portfolios. And once it's in, it doesn't leave because now it's policy. Look, institutions don't fear volatility, they price it. What they fear is being the outlier, the CIO who bought Bitcoin and got crushed in one of those drawdowns, even if the math was solid. This is why ideas like Bitcoin take so long to break through. After all, as Keynes said, paraphrased, it's better for your reputation if you fail conventionally than if you succeed unconventionally. And so they wait, they watch, they need a bridge. That right there, that picture, that was me. That was me just a few years ago. So what finally got them off the sidelines? Well, up to last year, Bitcoin faced significant structural barriers. ALM, committee review, fiduciary optics, as we just talked about, and all of that kept Bitcoin on the outside. But this changed with the introduction of the spot Bitcoin ETFs. Once Bitcoin got ETF structure, once it was custodied by BlackRock and Fidelity, traded on the New York Stock Exchange, got the nod of approval from the SEC, and it cleared institutional compliance, then it crossed the institutional Rubicon. It became normalized. It became allocatable. And now that that bridge exists, institutions are already crossing it. Just look at what happened to IBIT. When BlackRock, Fidelity, and Bitwise launched their spot ETFs, it wasn't about convenience, it was about permission. Now a CIO can walk into a boardroom and say, this isn't a fringe trade, it's a compliant product from the world's largest asset managers, and it trades on the New York Stock Exchange, and it sits with our prime broker. That changes everything. Bitcoin didn't become investable when it hit $100,000. It became investable when it hit the institutional compliance stack. And it's not any surprise then that IBIT, BlackRock's spot ETF, is the fastest growing ETF in history, reaching $70 billion in just over a year, 5 times faster than GLD, the previous record holder. So this isn't speculative money, or not just speculative money. It's fiduciary capital that's finally been given the green light. All right, so before we go any further, let's dive a little bit into Bitcoin itself and some of the regulatory drivers that have and will continue to be tailwinds over the long term for Bitcoin. So you've heard the saying that Bitcoin is digital gold, but let's drill a little bit deeper. The reality is that gold is analog money. Bitcoin is becoming digital money. As of now, it's digital capital. Neither gold nor Bitcoin should be dismissed. They are not mutually exclusive, and they have different benefits and risks. Both are scarce assets and sound money. But Bitcoin has emerged in this quickly digitizing financial world. Institutions are now learning that Bitcoin is not just digital gold, it's monetary architecture built for a world of endless mistrust, constant overreach, and oppressive inflation. It has no central issuer, no credit risk, no dilution. Its monetary policy is embedded in its code. Only 21 million Bitcoin will ever be created. Full stop. It clears 24/7, it's borderless, it's programmable, and it's neutral. And in a multipolar world where sovereigns are questioning the dollar system and seeking neutral reserves, Bitcoin is the first digital asset that offers true and trustless neutrality. All right, so you hear all kinds of words describing Bitcoin like decentralized, immutable, divisible, portable, scarce. If you have been resistant to learning about or accepting Bitcoin as a legitimate asset, I urge you to reconsider. It took me years to figure this out, and it could have taken me hours. But let's do a simple one-on-one on these. So I'll make it quick for you for the new ones. Bitcoin is decentralized, governed by tens of thousands of nodes, fully distributed across the world. Bitcoin's protocol is highly tamper resistant. Bitcoin has no central authority. The network of nodes validate this network right here validates and records all transactions, and they keep each other in check. Decentralization ensures that it has no single failure point. No entity, be it a government, bank, corporation, or individual, can control or manipulate the system. All transactions settle on a transparent, open network. That's why it's ridiculous when you hear politicians and people who are uninformed that say that it's the preferred money for illegal activity. It's not. The US dollar is. It's stupid to put transactions that are illegal on the Bitcoin network. It's there for everybody to see forever. Bitcoin is immutable forever. Secured by the most powerful computer network that spans the world, it's rapidly growing stronger. Okay, so it uses proof of work, which is a mining protocol. And so the Bitcoin network's annual energy consumption is 180 terawatt hours per year. So for those of you who aren't electricians or electrical engineers, I wasn't, that's equivalent to 21 nuclear reactors, full scale, running continuously 24/7, 365 days a year. And this prevents the network from being attacked, compromised. It's more energy than that of Ireland, Denmark, Greece, Portugal, Hungary, Switzerland, Czech Republic, Belgium, Finland, Austria, Norway, and many others. The Bitcoin network has operated continuously since 2013, processed over 1.1 billion transactions, maintaining over 11 years of uninterrupted service. Put simply, the Bitcoin network is a fortress of digital power, and it's nation-state level resistant, and it's growing stronger every day. Bitcoin's also nearly infinitely divisible. Each Bitcoin is divisible into 100 million parts called Satoshis, so everyone can use it. It's able to handle hundreds of billions of microtransactions daily. But don't confuse infinite divisibility with infinite supply. Just like a dollar can be split into 100 pennies or a pizza can be cut into 8 or 12 slices, the dollar and the pizza don't get any bigger, and neither does each Bitcoin. And remember, their dollars are not limited. You can keep printing them. So that's why the dollars, the fiat melts. Bitcoin is limited to 21 million only. That's it. Bitcoin is portable. It's borderless, which means it can be sent or received anywhere in the world at any time within minutes. Unlike physical money or gold, which are cumbersome to transport, Bitcoin's digital nature makes it highly portable. You've all seen the photos and videos of gold and cash being confiscated at the border of hostile countries. You can have $1 billion or more, and all you need to do, like I can have $1 billion of Bitcoin, and all I need to do is memorize 12 words, my keys, to take Bitcoin with me anywhere in the world. But I'm not really taking it with me. It's there already. It's already wherever I go. This feature makes it an ideal global currency, especially for cross-border payments or financial inclusion in remote regions. Bitcoin is scarce. You've heard me say it a few times now. With a hard cap of 21 million Bitcoin that will ever be created, Bitcoin is truly limited in supply. So do the math. There are over 60 million millionaires in the world. Only 1/3 of them can ever own a full Bitcoin, and far, far fewer will. In short, Bitcoin is a deflationary asset that cannot be debased by like fiat currencies. This is why you often hear Bitcoin described as digital gold and a hedge against inflation. But in this way, it's even better. And Bitcoin is catching on, slowly but significantly. But it's simple. Bitcoin already trades over $50 billion a day. It settles in real time with full public ledger transparency. It has no balance sheet, no counterparty, no central bank allegiance. You can't say that about real estate. You can't say that about gold. You certainly can't say that about private credit. Bitcoin is the only uncorrelated global liquid hard capped asset that exists, let alone earn it. That alone right there earns it a spot in your portfolio. So let's peek at what happens. Let's peek at some of the drivers behind it. We talked about the introduction of ETFs, and now we have listed options on ETFs too. These are super important to the investment community, and they provide the ability for effective risk management, particularly hedge funds, family offices, and proprietary books that use it for liquidity management. So that's a tailwind for Bitcoin. And we're going to talk about some of the regulatory drivers here on top of this. First of all, you had the FASB accounting rule change, which a little over a year ago, it addresses the accounting for companies that own and hold Bitcoin. So the new guidance requires entities to measure certain Bitcoin at fair value, which changes in fair value recorded net income with each reported period. See, the old rule was asset impairment. It meant that if you bought Bitcoin and it went down, you had to hold it at the lower of the purchase or the lowest price that it traded to. Asset impairment. And even if it traded up, you had to keep it at that low price. So if you bought it at 50,000 and went to 20,000, you had to hold it at 20,000. Even if it went to 60, 70, 80,000. If you wanted to realize that, you had to actually sell it in the market to realize that, that profit and make the asset unimpaired. But the new rule changes that. Now you hold it at fair market value. You market to market. So these amendments became effective last December. It's a really big deal. About a year ago, after the SEC had issued a staff accounting bulletin, the bulletin SAB 121 made it extremely onerous and possibly against accounting rules for banks to hold crypto and Bitcoin on their balance sheet. Banks then avoided having to do anything with the space, which was a key aspect of what you may have heard called choke point 2.0. But after a lot of embarrassment of the end zone run the SEC made around them, avoiding legislation, Congress repealed SAB 121 with a vote. But of course, that appeal was overturned by executive order of Biden, and so it went back into effect. Then when Trump took office and Gensler resigned from the SEC dissolved SAB 121 with SAB 122. So what does this mean for banks? This goes far beyond just buying Bitcoin in your bank investment account. It allows banks to hold Bitcoin without making them hold it as a liability, even if it's the customer's asset. So banks like JP Morgan Chase are already working on products around Bitcoin, collateral products, lending products, borrowing products. Imagine using Bitcoin as collateral for a loan or a mortgage without ever having to sell it and having to realize that tax event. This is a huge deal. They're all working on it. It's going to go mainstream at the banks very soon. But the political landscape continues to change dramatically. Trump just created a Bitcoin strategic reserve through executive order, whereby the government can add Bitcoin to its balance sheet in a budget neutral way. On top of this, the Bitcoin Act was reintroduced to the Senate recently and spearheaded by Senator Cynthia Lummis out of Wyoming. She now has multiple co-sponsors. And the act proposes that the US government buys 200,000 Bitcoin per year over 5 years for a total of 1 million Bitcoin. That's 5% of the total Bitcoin supply, and would roughly mirror the size and scope of US gold reserves. Just imagine if the US started buying Bitcoin and announced that they had. That sets some game theory in play for all other fiat governments, that they have to start buying it too. And most recently, as Laura had led into, we have the Genius Act. The Genius Act, after passing both the House and Senate, was signed into law by Trump enacting it. Implementation still depends on final rulemaking from federal regulators and state banking authorities, but it's happening. And though not directly related to Bitcoin, it's a really big deal and will have major impact on furthering Bitcoin adoption. We'll get into the details and importance of the act in a moment, but first, an introduction into stablecoins for those new to this fast-growing space. Put simply, stablecoins are digital assets, cryptocurrencies, designed to maintain a stable value over time. By pegging their price to a reference asset, such as a fiat currency or a commodity like gold or even a basket of assets, they maintain that stable value. See, the goal of the issuer of stablecoins is to combine the transactional benefits of a cryptocurrency, the fast settlement, programmability, global accessibility, with the daily price stability of fiat currencies. Stablecoins like USDT and USDC are used by traders to move assets across exchanges, crypto exchanges, or park some of their assets in a cash-like instrument, much like a money market fund, during periods of uncertainty. So unlike traditional banks, which are bound by business hours, liquidity limits, and regulatory challenges, US stablecoins offer real-time settlement, global accessibility, and integration with smart contracts. You all have experience sending a wire that takes an extra day or two, or goes to the wrong hole, or that gets lost and they can't find it. That just eliminates that. And wires cost $25, $40, $50 per wire. These are immediate transactions that are nearly costless. So because of all that, the stablecoin market is it's just marched ahead, continuing to grow in both importance and size. So now the USD and USDC now are worth over a combined $200 trillion. This chart is actually a month old, so it's even larger now. And this isn't gone unnoticed. This growth, now the U.S. Treasury sees U.S. dollar stablecoins as a strategic extension of the dollar's reach. I can tell you that I was up and we were talking to congressmen and senators and their aides almost 2 years ago, and they were well aware of the importance of stablecoins. We're going to get into why right now, because they understand that the Treasury needs them. See, stablecoins, particularly those pegged to the US dollar, like USDT and USDC, function as digital versions of dollars. They're accessible globally with just a smartphone and an internet connection. And so this expands the dollar's reach into regions without robust banking system. So, and to maintain their one-to-one peg, stablecoins must be backed by high quality liquid assets. And so for most major issuers, that means primarily holding one specific type of security to follow the US dollar. You all know what that is. It's a US Treasury bond, which gets us to the Genius Act. Officially named the Guiding and Ensuring National Innovation for U.S. Stablecoins Act, the Genius Act is a bipartisan legislative proposal backed by Senators Bill Hagerty, Republican from Tennessee, and Kirsten Gillibrand, the Democrat from New York. Right, there's some key provisions of the act. First, there's federal licensing. Issuers with more than $10 billion in circulation would require a federal license and be subject to oversight. The full reserve backing. Stablecoins must be backed one by high quality liquid assets like U.S. Treasuries or cash. Mandatory audits. Issuers would be required to undergo regular independent audits and publish their reserve data. You have dual regulatory tracks. So the smaller issuers under $10 billion can also operate, but they're under state oversight. But that keeps the ecosystem open to startups, which is good. They're also the CBDC alternative. The bill expressly supports private sector US dollar stablecoins as an alternative to central bank digital currencies. If you don't know what those are, please study them. They're horrific. They're evil. We don't want them. But this brings us to the impact of the Genius Act and stablecoins on Bitcoin. So by creating a framework for payment stablecoins, it further legitimizes the entire digital asset space. It further lowers psychological and legal barriers to Bitcoin and Bitcoin allocation. Effectively, as stablecoins get the green light, Bitcoin becomes the obvious next step. Today, much of the Bitcoin demand globally is intermediated by stablecoin liquidity pairs, USDT, USDC, meaning you trade your USDT or USDC for the Bitcoin on exchange. You can't do it with US dollars. You have to buy something like this. Or you have to do it through your exchange that goes out and buys it for you using the dollars that are in your account. So with the Genius Act compliant stablecoins, though, US banks, fintechs, and brokerages can offer them at scale, dramatically widening on-ramps. Every compliant stablecoin dollar in circulation sits one click away from Bitcoin on exchanges. Expect higher trading volumes, lower spreads, and easier access, all pushing capital flow toward Bitcoin. One of Bitcoin's core value propositions is its auditability and its transparency. We talked about that. The Genius Act requires proof of reserves for stablecoin issuers, clear attestations of dollar collateral. This standard sets the stage for investors to start comparing fiat-backed custodied assets like stablecoins versus a provably scarce bearer asset like Bitcoin. As people see stablecoin reserves are just dollars and T-bills, the contrast with Bitcoin's algorithmic scarcity will highlight Bitcoin as the superior long-term store of value. Remember, we were talking about the 10-year Treasury, how problematic it is. Stablecoin issuers under the Genius Act must back coins with short-term treasuries and cash. As circulation grows into the trillions, this will just funnel demand into U.S. debt markets, but it also exposes stablecoins to the U.S. fiscal risks, deficits, downgrades, debt ceiling fights. They're just endless. Investors seeking an escape valve from government liabilities will increasingly look to Bitcoin. In other words, stablecoins pump liquidity, but Bitcoin soaks up distrust in the underlying system. The bottom line, the Genius Act doesn't name Bitcoin, but it turbocharges the Bitcoin adoption funnel. On-ramps expand, stablecoins proliferate through banks and fintech. Liquidity deepens, Bitcoin trading pairs thrive. Trust shifts, stablecoin reserve exposures highlight fiat fragility. And institutions pivot. With regulatory clarity, Bitcoin becomes portfolio eligible for them. And when they do add it, the performance of Bitcoin can change dramatically. I mean, the performance of your portfolios can change dramatically. Let's look at how. So looking at the traditional 60-40 portfolio, 60% stocks, 40% bonds, over the past decade returned 127% for an annualized return of 8.5%. Not too bad. You beat the expansion of the money supply by over 1%. Replacing just 1% of the bond portfolio, though, with BTC boosts your return to 153% and 9.7% annualized. Better, adding 5% Bitcoin more than doubled your returns to 275% with a 14.1% annualized rate. For the bold, who added 10% Bitcoin, quadrupled the returns to almost 500% with a nearly 20% annualized rate, 19.5%. But if that doesn't convince you, get this, your Sharpe ratio or your risk-adjusted return goes up with each amount of Bitcoin that you add. And with 10% Bitcoin, you jump over that magical asset allocator 1.0 Sharpe ratio, hitting 1.13. Think about that. A 5% Bitcoin allocation, no leverage, no derivatives, doubles returns and significantly improves the risk-adjusted profile. And 10% kicks it up even further. For any allocator managing volatility or tracking error, that's not just compelling, that's portfolio engineering. And it's not about betting on Bitcoin. It's about using it as a convex payoff in a world where traditional assets are delivering linear risk and negative real returns. And so many of you have seen this chart before, and some of you have. This is by Jesse Myers, and he lays it out clearly. Global investable assets are now $1 quadrillion. Yes, Bitcoin is the smallest of them all, but gold has been around for thousands of years, and Bitcoin is already 1/10 its size in just 15. Some quick math here. If Bitcoin captures just 1% of global assets, that's a $10 trillion valuation, a 5x from here, without requiring retail FOMO. And the first institutions to allocate, they're not waiting for validation. They're positioning for scale. Here's a report from Gemini and Glassnode just the past month. They found that over 30% of Bitcoin's circulating supply is now held by just 216 centralized entities. This means that it points directly to deepening custodial centralization, which means expanding institutional adoption. Since early 2015, the total Bitcoin held across major institutional and custodial entities is surged to 6.2 million BTC, or an increase of 924%. Look, most institutions manage multi-generational capital. They don't chase trends, but they all share the same pressures: duration mismatch, underperformance, and currency concentration. Here we see a survey of institutional managers who have allocated to Bitcoin. In the last 3 years, diversification has emerged as the top reason for investing, overtaking speculation. Despite the common belief that speculation is the main driver, it now ranks as the third or fourth most cited reason, often coming in below client demand and diversification. As fiduciaries, institutions are forced to ask the question, what assets survive if trust in sovereign money continues to erode? Bitcoin doesn't need 50% allocations. It needs 1% from the right players, because when they allocate, they don't sell, they rebalance, they normalize it. Bottom line, Bitcoin is the default escape valve, not a rebellion, a refuge. And it'll soon become the pillar asset that portfolios are built around. We are witnessing the quiet institutional adoption of Bitcoin, not through hype, but through structure, through process, through risk models and due diligence memos. And that's what makes this moment so powerful. Bitcoin isn't being pushed, it's being pulled by the same system that once dismissed it. You've seen what's broken, you've been shown the exit, the infrastructure is built, the capital is moving, and now you have a choice. You don't need to believe in Bitcoin, you just need to believe in math.